Hello everybody and welcome to this video where we'll be running over the top 4 telecommunication service companies. So first we want to take a look at whether these companies are in what we consider an uptrend and a downtrend. So we want to look at the most recent periods and see how the stocks have been performing. As we can see here, stock performance year to date on AT&T, they're down with minus 29.22. A big reason for this is that on the media side of their business has been doing really poorly. They have lost a lot of subscribers on HBO. Moreover, on the business plan side, they have lost a lot of customers to, among others, T-Mobile US. Verizon here down with minus 3.86, so a more flat. Again, they are also being threatened a bit by T-Mobile US and have lost some market share to them. But again, it's otherwise pretty stable. T-Mobile US, again, as you can see here, up with 50.60%, so really doing well. And that is due to several different reasons. One of them, as just mentioned, they have managed to capture market share revenue from some of the other companies. Moreover, they have done a big acquisition of Sprint, where they believe that there will be big synergies around $6 billion per year. T-Mobile US has done other acquisitions where they've actually outperformed on this part. So there's big expectation for this, and it will put them in a position very strongly on the 5G network where their coverage will be the best among all the three of them. Lastly, we have here Lumen Technologies, formerly known as CenturyLink. They just did a rebranding of their companies. It is down with 25.36%. They have also been struggling quite a bit in the area, and they are trying to do this rebranding to Lumen Technologies to show a new path, as they call it. It's the way into the fourth industrial revolution, and they believe their offerings, which consist among others on fiber network and cloud-based services, to be positioning themselves for growth in the future. So they are seeing this way of changing their name as the company to be seen in a new light. They will still keep the old CenturyLink brand for small business consumers, but otherwise it's going to be known as Lumen Technologies going forward. Next, we want to take a look at the income statement part, and we basically want to understand whether these companies are earning money as of today. So if we take a look at the net income here for the last 12 months, we can see that all of them are earning money, and it's going pretty well across the board. If we take a look at the net profit margin, which is benchmarked against the industry, we can see that AT&T, Verizon, T-Mobile US, and Lumen Technologies are actually doing pretty well, whereas Verizon is doing the best here with 15.17%. We can also take a look at the B/M score here, which is a mathematical model that determines whether a company has manipulated its profits. We want this to be below minus 2.22, and we can see everybody with the exception of T-Mobile US is actually doing fine. However, the number for T-Mobile US is nothing of a big concern. We can also take a look at the Sloan ratio, which identifies if a substantial part of earnings are non-cash accruals. We are not interested in that. We want this number to be between minus 10 to 10%, and all of them are living up to that. So we have a situation here where we have the two big players, AT&T and Verizon, who is being threatened by T-Mobile US, who is trying to do this being more cheap than the others, and we will see that in some of later in this presentation. And lastly, we have Lumen Technologies, a smaller player who is trying to rebrand itself. So if we take a look at the overall ranking, we first looked at the stock and the trend, and what we could see was that AT&T and Lumen Technologies were in a downtrend, Verizon was more stagnant or sideways, and T-Mobile is in an uptrend. On the net income part for the last 12 months, all of them were positive, which was good. On the net profit margin, Verizon was the best, followed by AT&T, Lumen Technologies, and T-Mobile in the end. Next, we want to take a look at the return metrics and understand how high returns and cash flow margin is being generated. If we first take a look at the earnings yield benchmarked against the S&P 500 average, we can see that AT&T, Verizon, and Lumen Technologies are outcompeting the S&P 500 average, while as T-Mobile US is doing poor with only 2.41%. On the return on invested capital benchmarked against the industry, actually all of them are not performing that well. So AT&T 2.26%, Verizon doing much better though with 8.88%, T-Mobile US again the worst with 2.08%, and Lumen Technologies with an okay 4.67%. Next, we can take a look at the levered free cash flow margin. As you know, that is very important to me. So AT&T really well, 14.84%. The same with Verizon and 16.30. T-Mobile US again really poor with minus 3.72. And Lumen Technologies again respectable 14.15%. Next, we want to take a look at the balance sheet and ratios and understand how strong the financial position are of these companies. Again, this industry is characterized by a lot of acquisitions. You can name AT&T, who bought Time Warner. We just mentioned T-Mobile US, who did the Sprint Energy acquisition, and so forth. If we take a look at the current ratio and the cash ratio, we want this to be above 1. And we can see it's the only situation where somebody surpassing this is T-Mobile US and the current ratio. If we take a look at the total ratio, total asset versus total liabilities, we want this to be above 1.5. We can see that AT&T and T-Mobile US just delivers on that, while as Verizon and Lumen Technologies are doing a bit worse. But again, it's nothing that really stands out as being really bad. On the debt equity ratio, it's more or less a similar story. AT&T doing the best, followed by T-Mobile US, Verizon, and then a small red flag here on Lumen Technologies. However, I would say that over the past year, they have managed to reduce their debt, so they're on the right path. We can also take a look at the Altman Z score, which is just a credit strength test that assesses the likelihood of bankruptcy. We want this to be above 1.8. None of these lives up to that, so that's maybe a bit related to the industry that we are in, with the exception of Verizon, which is getting closed on 166. Another way is to look at the Piotrowski score, which is another way to assess the strength of the company's financial position. We want this to be equal or above 5, and here we can see that all of them are above, so that is a good sign. So back to the overview, we first looked at the return on invested capital, and what we saw was that Verizon was the best, followed by Lumen Technologies, AT&T, and T-Mobile. On a levered free cash flow margin, Verizon, AT&T, and CenturyLink was all doing really well, while as T-Mobile was pretty poor. On the total ratio, AT&T doing the best, followed by T-Mobile, Verizon, and Lumen Technologies, and the similar story on the debt equity ratio part. Next, we want to take a look at the shareholder yield and understand how much value is returned to shareholders through the form of dividend and or buyback. So if we first take a look at the dividend yield here benchmarked against the industry, we can see that AT&T is paying a really good 7.48%, Verizon acceptable 4.18%, T-Mobile US not paying anything, and Lumen Technology is paying a really solid 10.48%. So for dividend-oriented investors, there is definitely some value to be captured here from some of these companies. On the buyback yield part, we can see that AT&T issued shares, so they have a minus on 2.81%, nothing on Verizon, minus 0.21% for T-Mobile US, so a very small issuing of shares, and nothing on Lumen Technologies. So that gives us total shareholder yield, which is acceptable for AT&T and Verizon, nothing worthy to mention for T-Mobile US, and a really solid 10.48% for Lumen Technologies. However, we obviously want to understand whether this is sustainable in the future, so we therefore look at the modified payout ratio, which shows the proportion of earnings that is paid to shareholders in the form of dividends and a buyback. We want this to be below 100% because that means that there's room for further growth in either dividend and or buyback. If it's above 100, it shows that it's unsustainable in the future. So if we look here both at AT&T, Verizon and Lumen Technologies, they definitely have room to improve, especially for Verizon, which has only 51.45%. So besides the shareholder yield section just run over, this is probably the most important one when looking at these companies. First, we can take a look at the PE ratio benchmarked against the industry, and it's looking very attractive across the board, especially when you see that it's still green for T-Mobile US on 38.12. It puts it into perspective when you see 9.76 on Lumen Technologies. It seems like from a P ratio perspective that there's a lot of value for these companies. We can also take a look at the earnings per share growth forecast for the next 5 years, which illustrate that this is not huge growth industry. AT&T 0.29%, Verizon 1.64%, and minus 1.40% for T-Mobile US, a bit surprising to me, and 1% for Lumen Technologies. We can also take a look at the revenue growth for the last 12 months, and this tells very well the story of AT&T, minus 8.91, which is probably one of the reasons that their share price have dropped. Similar story here with Verizon, minus 5.06%. T-Mobile US, impressive 60.95%, which is again an illustration of that they have managed to grow their revenue quite significantly on the expense of AT&T and Verizon. They have done so by offering acceptable services at a very, very low cost. So again, they don't earn a lot of money, but they are capturing market share. And again, T-Mobile US have just acquired Sprint, which is going to be very interesting to see how they're going to handle this acquisition. It means that they will become huge in terms of coverage on the 5G network, going to have more coverage than both AT&T and Verizon. Lastly, we have here Lumen Technologies, which is also in a bit of a stagnant phase with minus 3.40%, which again is maybe one of the reasons why they are doing their rebranding. We can also look at the net profit growth for the last 12 months. AT&T doing really poorly here with minus 31.87%, so definitely a warning flag for them and something they need to have a look at. Verizon, really, really solid number with 42.50%. T-Mobile US minus 14.20%, which again shows that they have grown their market on the expense of their profitability. And lastly, Lumen Technology is really surprising number here, but 56.75%, really, really good number. So back to the overall ranking, we first looked at the total shareholder yield, and Lumen Technology had a very interesting one, the same with Verizon and AT&T, while as T-Mobile is paying nothing. On the EPS growth forecast for the next 5 years, there was not a big difference between the companies, but Verizon was doing the best, followed by Lumen Technology, AT&T and T-Mobile. On net profit growth for the last 12 months, Lumen Technology again doing the best, followed by Verizon, T-Mobile and AT&T. We then obviously want to understand whether these companies are currently under or overvalued, and one way of looking at that is to look at the Peter Lynch fair value, who used the PEG ratio to determine whether a company is overvalued or undervalued. If the PEG ratio is below 1, they are considered undervalued. If it's above 1, they are considered overvalued. And as we can see here, AT&T, Verizon and Lumen Technologies are all overvalued, while as T-Mobile US we cannot assess that because they have a negative earnings growth forecast. Next, we can take a look at my own estimated intrinsic value that is based on a lot of different assumptions and numbers, and basically the fair value upside or downside estimate for the different companies are that AT&T has an upside on 14.91%, so really good, small 3.10% on Verizon, a minus 8.03 on T-Mobile US, and an 11.04 minus on Lumen Technology. We can also look at the beta ratio, which is just showing the stock's volatility in relation to the overall market. If it's above 1, it's considered more volatile than the general market, and as we can see here, all companies are below 1, so they are less volatile than the general market. We can also take a look at some other value indicators, and one of them is the book value per share. And basically, if that is above 1, it means that the companies are undervalued. If it's below 1, they are overvalued. And very interestingly here, both AT&T and Lumen Technologies are considered undervalued, while as Verizon and T-Mobile US is considered overvalued. We can also take a look at the relative strength index for the last 14 days. We want this to be below 30 because it means that it's oversold and most likely will go in a reverse uptrend. If it's above 70, it is considered overbought and it may therefore pull back. So if we look again, very interestingly, AT&T is in oversold territory, while as all the others are in the middle range. Lumen Technology is getting a little bit close to the 30 mark, but so far staying above, so no clear indication on them. Lastly, we can take a look at the analyst recommendation. What are they thinking? Again, I don't use them blindly because they quite often have their own interest, but if the number is proven, I think it's always good to stay on the same side if possible. So if we use their consensus price target, which is basically just the middle ground of all the estimates that the different analysts are providing, then we can see that they believe that there's a 21.50% upside on AT&T, small 5.37% upside on Verizon, very small 0.33% upside on T-Mobile US, and a 5.03% upside on Lumen Technologies. So they believe that all companies has room for improvement. Some think that it's higher than this, some of the analysts think that it's lower. So to round off the overall ranking, we looked at the intrinsic value of these companies, and based on the overall value assessment, we believe that AT&T is considered undervalued, Verizon and T-Mobile is considered fair valued, and Lumen Technology is considered undervalued. So to round off today's video, we just want to emphasize that it was not really easy to select the top pick of today. The sole reason for this is that we actually believe that depending on which type of investor you are, you may prefer one of these stocks over the other. However, if we should select one among the 4, it would be based on a respectable free cash flow of 14.84%, lowest debt equity of 0.79%, attractive total shareholder yield of 4.67%, and most importantly, it is undervalued on almost all the parameters that we are looking at. We therefore have selected AT&T. This is a mixture of attractive from the shareholder yield perspective, but we also believe that there could be some upside in AT&T if they manage to reverse the decline in the business. This may be very much subject to the development on the coronavirus. However, we still believe that based on these factors, AT&T is a good and safe pick, because even if they don't really revert fantastically on the business, the shareholder yield is going to be great going forward, and we would therefore not be concerned to put AT&T in our portfolio and just let it lay there for some time. It is part of an industry together with Verizon and T-Mobile US, who is almost dominating this market, and there's room for all 3 companies. We also want to stress that all the others are actually pretty good picks. Verizon overall is probably the ones showing on average the best numbers in the industry. So they are also a very good safe pick. They have a good shareholder yield as well. However, because we feel that there's not so much room for upside on the share price itself, we disregarded this compared to AT&T. T-Mobile, on the other hand, is for the people who are seeking growth. There's definitely still, even if we believe that it's fair value, on the long term, if T-Mobile managed to successfully integrate Sprint, there's going to be huge upside on this stock from a growth perspective, but it's very much depending on this. And we just feel that with the price as today, we don't think it's worthwhile to go in yet, but if there comes a pullback, we'll definitely consider to look into T-Mobile as well, because they have in the past been successful with their acquisitions, and we believe that they can be so again. The dark side, or the dark horse of these companies, is definitely Lumen, because they provide a very, very attractive total shareholder yield. They have a good free cash flow. It looks pretty sustainable. This whole rebranding of the company may attract new customers. They may successfully enter into new markets. They want to expand a bit their business in other areas. So there could also be a huge upside on them. So again, I wouldn't disregard Lumen as of today. Maybe wait a bit to see how things develop in the coming months, but we actually may enter into a position on these as well, because it looks attractive, and again, they have a very attractive shareholder yield, which will look certain, at least for the time being, with the numbers that they are presenting. This was all we had today. Please keep in mind, we are not professional advisors. This is purely for entertainment purposes. You need to do your own due diligence. Check these stocks before you take an active investment decision. We though hope that you enjoyed this video. If you did so, please subscribe to our channel for future content. Please provide a comment if you have any suggestions for improvement. Share with your friends. Otherwise, have a nice day. See you next time.